Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. Here we are on a Thursday. You can see midday mortgage-backed securities bouncing back nicely from the Wednesday Fed meeting. 10-year note back down to 149. Wonderful. NASDAQ loving the lower rates. So let's talk about a little bit of what happened. First off, the Fed came and they talk about some of the big takeaways. They obviously pulled forward their rate hike scenario. Remember, their original forecast just a few weeks ago was for the first rate hike in 2024. Now they're talking about at least one in the beginning of 2023, March, so it's like 9 months sooner, and maybe a couple more after that. Caution, doesn't mean it's going to happen. They even said so. So they call these dot plots, like this is what we're forecasting. But then the chairman even said, hey, but don't rely on the dot plots. They're not an accurate indicator of when the Fed is going to actually get into liftoff or start hiking rates. Assuming that that is the case, that we are going to hike rates in the beginning of 2023, which is still a long ways off. We have to see the data get there. So if the data supports it, that would be a reason why we could certainly hike in 2023. But the other big piece is the Fed's bond buying program will have to start tapering well in advance of that, because the tapering portion comes before the actual rate hike. And so the market was a little spooked initially, and you can see here, big red candle, but here we are back on a Thursday, bouncing right back. So it looks real nice. So what I would be looking at and sharing with clients, and what we're thinking about at Mortgage Market Guide and sharing with our membership and telling their clients is that, hey, we're not going to know if inflation is indeed, the high inflation is going to be transitory. It's going to take some time. We also don't know how the labor market still needs to do a lot of repair work. We had 9 million people looking for 9 million jobs open. So we got to get people back to work. And that process isn't as going as robust as thought. The last couple of jobs numbers were not very good. So we have to watch the data. And that's why, a client or a partner working with a professional like yourself is so important, because you got to bring in these insights. I think, this last 48 hours is a perfect example of how volatile our world is, and how a need for some guidance and some insights as to what this all means, because it was pretty hectic. So next week, what we're looking at, besides the technicals and this bounce back and the 10-year note at 150, I think that's fantastic. It'd be great to get back beneath it. But there's some data, right? And now that we're entirely data dependent, and the Fed just said it, we're going to be watching the data. It's not one report; it'll be multiple reports looking for trends. But next Friday is the Fed's favorite gauge of inflation, the core personal consumption expenditure index, and so how that report goes could have an effect on which way rates go. And I would be looking at that month-over-month number rather than just the year-over-year, because we already know that's going to be hot. We want to see how inflation is running on a month-to-month basis. So I hope this finds you well. Have yourself a terrific weekend, and we'll talk to you soon. Bye for now.